My guest today is Professor Carmen Reinhart, who's professor of international finance and economics at Harvard Kennedy School. From 2020 to 2022, she served as chief economist at the World Bank. She was also policy advisor and deputy director at the IMF, a member of the advisory panel of the Federal Reserve Bank of New York, and Congressional Budget Office panel of economic advisors. Welcome, Carmen.
Thank you.
Yeah,
Can you hear
so
me?
yeah, I can. Yeah, so I got
Very
a
good.
number of your papers, Carmen. So I want to sort of step through them. The first one is sort of a context setting paper. So you say here this entitled Sovereign versus Corporate Debt and Default, more similar than you think. You say here theory suggests that corporate and sovereign bonds are fundamentally different, also because sovereign debt has no bankruptcy mechanism and is hard to enforce. We show empirically that the two assets are more similar than you think, at least when it comes to high yield bonds over the past 20 years. We use rich new data to compare high yield US corporate bonds, sometimes called junk bonds, to high yield emerging market sovereign bonds. I would imagine these are emerging market bonds. 2002 to 2021, investor experience in these two asset classes were surprisingly aligned. Similar average excess returns, similar Sharpe ratios, similar default frequency, and comparable haircuts. So, yeah, it's a little bit of a surprise for me, Carmen. So, I thought sovereign debt is very, very different from corporate debt. Clearly, they have the underlying risk characteristics appear to be the same. That sort of make some intuitive sense. But toward the end, they behave very differently, I would imagine, right? But I mean by toward the end is the default.
So look, sovereign debt encompasses a lot, as does corporate debt. But the quality of the borrower, the perceived default risk of the borrower is all over the map, right?
Yeah.
So indeed, we would not dream of comparing a sovereign bond, a sovereign bond of, say, a Germany or a US, or notwithstanding its debt challenges, Japan,
Yes.
with high yield corporate debt.
Yeah.
Okay. So where the similarities really kick in across the corporate corporate debt and the sovereign debt is really in the assessment of the default risk. And the closest you would get to the highly rated sovereign bonds would be highly rated corporate bonds, your AAA, certainly. And understanding that the sovereigns like you, our gut reaction is, well, there are mechanisms to deal with corporate defaults. There are very well established legal mechanisms. Nothing like that exists on the sovereign side. And yet, when it looks at how they behave, especially in response to economic shocks and over the cycle, they're quite similar. Meaning, let me give concrete examples. Risk on, risk off. Whenever you have anything, whether it is tightening of monetary policy, as we saw during the high inflation episodes, or you have a shock like the COVID shock, or a shock like the global financial crisis that pretty was, the US subprime crisis. And when you have shocks like that, investors commonly, the response is to withdraw from risk taking. And that hits the corporates, the high yield corporates, and it hits the sovereigns, the high yield sovereigns. It works the other way for safe assets, right? There's usually a flight to quality.
Yeah.
And so in these scenarios, whether the shock is, a global shock emanating from monetary policy or any other variant of these
Hmm.
global shocks, the response is retrenchment.
Hmm.
Now, we can get more granular, and we do get more granular. So I mentioned, three shocks. One is global tightening of monetary policy. That hit everybody, the
Yeah.
corporates and the high yield emerging.
Hmm.
COVID, again, pretty global, varying degrees of intensity, but it was a withdrawal from risk taking of alarming proportions
Hmm.
in the spring of 2021, especially. Uh, However, I also mentioned the global financial crisis, which was importantly a U.S. and advanced economy.
Hmm.
Emerging markets were not nearly as everyone was affected by the shocks in 2008, 2009,
Yeah.
but the financial sector issues, the banking problems were largely, an advanced economy, US, Europe, um, and
Hmm.
their emerging market bonds, sovereign bonds did better than the US
Huh.
corporates, for
Okay.
example. So,
It's a different
so
different kind of shock. Yeah.
it was, yes, because the
Yeah.
shock was more directed to the domestic market. And
Hmm.
it wasn't just your generalized withdrawal from risk taking. But again, the point of our analysis is that these, in principle, very distinct financial instruments
Yeah.
are often lumped together as, in the risk on, risk off
Hmm.
investment, uh, you know,
Hmm.
um, um, and there's good reason for that. That there's indeed quite a bit of similarities, and I'll conclude by saying that there's also, when we look at recovery rates, when we look
Yeah.
at you know haircuts,
Yeah.
there's they're quite similar in
They're
that
quite
respect.
similar. Yeah. So
Um,
I mean, it makes a lot of intuitive sense for me, Carmen. So for an investment manager, these assets may look sort of similar. Suppose my targets are beta, alpha, and Sharpe ratio, and I can find assets in the corporate world. These things meaning the sovereign debt, might seem sort of similar in many ways. But I wondered, so as the country, as a sovereign debt reaches some sort of default state, as you say here, bankruptcy is not in the picture. Um, do they behave very differently? So if I look at it longitudinally, a junk bond in the U.S. and some sort of sovereign debt, and both of them are going down, let's say, and I'm looking at it longitudinally, would I see something distinctly different? The sovereign
yes,
debt scenario? Yeah.
yes. So look, I think you hit on a very important point. Um, that because of the fact that corporates have, it doesn't mean that the resolution of corporates is automatically swift. It is not. It can be a very dragged down process whenever you get into legal issues. But the process of debt restructuring on the sovereign side is definitely a lengthy process. So if you look at
Yeah.
it, and I've written extensively on this issue, the restructuring process can be very
Yeah.
lengthy, as in
Yeah.
numbers of years.
Mm.
And importantly, B, which is very different from the corporate side, it can be serial restructuring, meaning,
Mm.
the uh, but what do I mean by serial restructuring? The investors, the holders of, the owners of the bonds get together with the sovereigns and come to a restructuring agreement. The restructuring agreement may deliver a haircut for the
Yeah.
creditors, but it may mean that that haircut is not sufficiently big
Yeah.
to resolve the debt overhang of the
Yeah.
sovereign.
So you got to do it
And
again. So
and
yeah.
so you go back
Yeah.
to it again. And there's this
Yeah.
recontracting. And that is definitely more in the
Hmm.
sovereign,
Yeah.
right, than in the corporate world. That is very different.
So
So
the
this is a very
outcomes.
important issue that you raise.
Yeah. Sorry to interrupt, Carmen. So if I understand this correctly, so the outcomes are much more uncertain toward or when you reach close to the default. In the sovereign case, the outcomes are much more uncertain, um, because the period over which you have to wait to get an outcome is longer. And as you say, serial restructuring, you can't really predict what the outcomes are. So in some sense, so this is interesting. I'm just thinking about from an investment perspective, Carmen. I don't know a lot about this, but if the investment manager has two different assets, sovereign debt and junk bonds, let's say corporate debt, and as things sort of go bad, I would imagine the investment manager will unwind the sovereign debt faster because of the higher level of uncertainty. Is that the way to think about it, or no?
I'm not sure that we can make that kind
No.
of statement because, there isn't full certainty on corporates. So
Yeah.
so and the we have a priori, we may have a tighter distribution in terms of if they default,
Yeah.
it will get resolved within X period. So we may have
Yeah.
a very tight distribution on that, but that is subject to the first part, which is if they default, and
Yeah.
if they default is still very uncertain. And so what I am getting at is that the corporates are also subject to sectoral shocks as
Uncertainty.
well. We discuss
Yeah. Yeah.
this,
Right.
and so um, if we restate what you said in terms of conditional probabilities, condition on them having defaulted, uh,
Yeah.
I have more certainty over the path of resolution for the corporate than for the
Yeah.
sovereign. That is there, but that is a priori. We have uncertainty bundled,
Yeah.
not just on how the default, if it occurs, will be resolved, but also uh, the likelihood of default in the first place.
Yeah, it's really interesting. I want to go to another paper, Carmen. So, sovereign haircuts, 200 years of creditor losses. You say here we study sovereign external debt crises over the past 200 years with a focus on creditor losses or haircuts. Our sample covers 327 sovereign debt restructurings with external private creditors over 205 default spells since 1815. Creditor losses vary widely, none to 100%, but the statistical distribution has remained remarkably stable over 2 centuries with an average haircut of around 45%. So, yeah, I mean, this is a very long time, very large data set, but we see a distribution that is sort of stable, right? That's what I understand.
Yes, yes, and I think um, if one looks at a distribution of, say, defaults by decade, breaks down
Yeah.
the 200-year period and looks at the defaults by decade, what you
Yeah.
see that in any given decade, if you randomly pick a decade from, the 19th century or the more modern era, you're going to see some creditor losses, some haircuts that are very large,
Yeah.
even one, although ones are
Yeah.
rare. Okay, I'll talk more
Yeah.
about that. And
Yeah.
some that are quite small, right?
Yeah.
So that distribution, that the spread, the dispersion
Mhm.
of the haircuts is a constant through time. And then we spend in that
Mm.
paper quite a bit also of, uh, you know, quite a bit of the analysis is also focused on what are the drivers of the
Mm.
size of the haircut. So
Yeah.
what can help us understand and even explain or predict,
Mm.
predict is a strong word, but can
Mhm.
help us assess whether whether a default will end up with an average haircut, a very large
Yeah.
haircut, or a more modest one.
Yeah. So you have some attributes. So you say if you further examine past predictors of the size of the haircuts and identify rules of thumb applicable to future defaults, poorer countries, first-time debt issuers, and those that borrowed heavily from external creditors all record significantly higher haircuts in case of a default. Geopolitical shocks such as wars, revolutions, or the breakup of empires
That's a big
deliver the
one.
deepest haircuts. Yeah. So it's very intuitive, but you see this in the data in a large data set.
And indeed, also, I don't know, I didn't catch it if you mentioned incomes per capita
Incomes per capita.
play,
Okay.
play a big role. And that's also intuitive, right? Because, some of
Mm.
the poorest countries have
Mm.
very limited access to private creditors.
Mm.
Most of what they borrow from official institutions, the multilaterals, the World Bank, and so
Mm.
uh, to have an effective debt reduction, you need a
Mhm.
bigger haircut, right? Because
Yeah.
um, uh, and also in connection with the first time issuers,
Right.
it's often these new entrants that are comparatively poor.
Mm.
So because if you look at even within the emerging market world,
Mm.
most of the borrowers, the sovereign borrowers, have been there for a long time, have been there for many decades.
Yeah.
In the case
Yeah.
of the Latin Americans, their independence, dates back to the early 19th centuries, and that they started to borrow in the 1820s and defaulted
Mm.
in the 1820s. So there's a
Mhm.
long history there.
Yeah.
But the history is much shorter, especially in parts of Africa where you had countries like Angola in
Mhm.
which the independence is 1975, and you really
Yeah.
can't talk about a sovereign default if you're not a sovereign. So
Yes.
so the
Yeah.
what the new entrants
Mm.
is usually also picking up is that these are also the more recent vintage, which are usually also overlap with some of the poorer countries.
Mm.
And as you mentioned, um, the biggest, hands down, predictor, which is really a misstatement to say predictor.
Yeah.
Ex post, you can say
Yeah.
they're big. Ex ante, who's going to
Yeah.
predict whether this will be a revolution or a civil war that will, but the fact is, civil wars, revolutions have delivered, um, the these are not haircuts, they're repudiations. right?
Yeah,
So
I mean,
so
so
that's a
let me
big
ask you.
difference.
So sorry, Carmen. So we go on a tangent a little bit. So I grew up in South India, and there is one attribute here that is potentially very predictable. You mentioned it, per capita income. A country like India has been touting they're the third largest economy in the world. Aggregate GDP is interesting, but it doesn't really have that much predictive power for anything. But income per capita does, right? So um, the most populous country in the world today, India, um, I think their GDP per capita is like $3,000 or something like that. China was there 20 years ago, 25 years ago, and we'll talk about China later. But they are 10 times that now. But India
But
was sort of, yeah. Go ahead.
no,
Yeah.
but I look, what we look at, just to be very clear, is the distance of a country's income from a global median. Okay.
Yeah.
For India, that distance, not as nobody's has shrunken as dramatically as China's, but that distance has shrunken. Um,
Okay. That
for
is, yeah.
some of the countries that we're talking, the countries that, Sierra Leone, Mozambique,
Yeah.
Laos,
Yeah.
for these countries, it's, not, so the
Hmm.
gap there's a very big gap between that median global income and the
Hmm.
income of that country. So, and we needed to do this. Think about what,
Hmm.
Gill, about the span we're covering. We're covering 200 years. So,
Yeah.
in other words, somebody that is poor today may have been very wealthy 150 years ago, in
Oh,
terms of, because incomes per capita have drifted higher over
yeah.
time. And so we always need to compare it to a benchmark for
Hmm.
that year.
Hmm. Hmm.
And so you're poor relative to
Hmm.
the global metric
Yeah.
for that period. That's really the more precise way of how
Yeah.
we captured um, the role um, of per capita incomes. But you also touched upon, and I thought you were going there with this, on regional differences within
Yeah.
countries.
Yeah.
Okay, we actually don't get into that because,
Yeah.
and China, notwithstanding its massive progress on nearly every front, has massive
Yeah.
regional differences to this day. We have
Right.
provinces in China that have defaulted,
Hmm.
but that's a sub-sovereign default.
Hmm.
That is not a sovereign default. So, the
Yeah.
United States had, more than a dozen states defaulting
Yeah.
in the 1800s, and West Virginia was in default till around World War One. But
Yeah.
that's
Yeah.
sub-sovereign. So we don't,
Yeah.
we stick in this analysis, just to be clear, to the sovereign level, not to. So because the issue for big
Yeah.
countries like India, like Brazil, like
Yeah.
China, the US, the
Yeah.
regional differences and disparities are also, pretty striking, but that's treated as sub-sovereign.
Yeah. I wasn't going there, Carmen, but I think it's really interesting. Um, and so we have a patchwork in these large countries, Brazil, India, China, and the US, a patchwork of regions that have different economic. I mean, India is like 26 countries put into one for governing convenience, but it is well. Let me not get into trouble. But it's a different thing, right? So I quite like looking at a sovereign the country's economics. And I also quite like this idea. I haven't thought about this, Carmen. The distance from global average per capita income and sort of the velocity and acceleration of that particular metric from the global average should tell us a lot about a country, right?
Indeed, indeed. And that's why looking at it vis-a-vis the relevant time period is important, because, I could, if I were to look at per capita income in several emerging markets today, you would say, oh, they were high income at an
Hmm.
earlier era. So, and we're pooling all this data together. So the issue of always having, the control for the global median, global average for the period is very important. But one more thing, of course, and
Yeah.
again, that I wanted to flag, and this is relevant. It goes back to the question we were discussing on investors and how long it takes to resolve sovereign debt crises. One important predictor of the haircut is
Yeah.
the length, the cumulative
Hmm.
decline in GDP since the onset of default. In other words,
Hmm.
the longer the restructuring process drags on,
Hmm.
the bigger the haircut. And this is interesting because,
Hmm.
investors often, understandably, creditors don't, they want to be repaid, right? They you
Yes.
you you made this loan, you want to be repaid. You bought this bond, you want to be repaid according to the contract. Um, and so they're very reluctant to take haircuts. And often the only
Yeah.
way to move forward is to incrementally with little haircuts. But
Yeah.
sometimes that strategy can also backfire, because
Yeah.
the longer it takes to actually resolve the debt problem of the country,
Yeah.
the bigger the economic contraction in the country, and
Yeah.
the less their capacity to repay. So haircuts
Yeah.
get bigger. So
Yeah.
in some cases, what it says is this real trade-off between understandably not wanting to take a haircut, but at some
Hmm.
point recognizing fairly quick that you need to bite the bullet, and it's better to get,
Hmm.
30 cents than to get 10.
And
Um,
wipe the slate clean. Start
yeah.
over. Yeah. Yeah. So we'll talk about this in the context of China, which is very interesting. So I want to sort of finish up this bucket of topics. The aftermath of debt surges. You say here debt in emerging markets and developing economies is at its highest level in half a century. In about 9 in 10 emerging markets and developing economies, debt is higher now than it was in 2010. And in half of the emerging markets and developing economies, debt is more than 30 percentage points of GDP higher than in 2010. Um, So debt now, I don't know what the time frame was this, but debt now, a part of it is COVID, wasn't it?
Well, it's COVID is singled
Yeah.
out often as, oh, look, debt surge, which
Yes.
is true.
Yes.
But and this, I made this point when I was chief economist at the World Bank. A lot of the debt problems in many of these countries
Yeah.
preceded COVID. And a big turning point is not unrelated to China and not unrelated to the crash in commodity prices. 2014, 2015 was the
Yeah.
year, especially beyond 2015, that China started to slow. China has a big imprint on global commodity markets. Commodity prices crashed. Now,
Yeah.
many of these countries, developing and emerging, that began to have that difficulties are commodity producers who saw the collapse in the
Mm.
price of their exports. So,
Yeah.
this is already this weakening in economic activity, in the terms of trade, in almost all the economic indicators begins to set in around 2015 prior to COVID. Then COVID comes in and, of course, makes already what was a frail situation much worse.
Right.
But, it has been, the book, for the children's book, a series of unfortunate events.
Yes. Yes.
This begins to sound like that, right? Because these very same countries that had been hit by the commodity shock, that had been hit by COVID, are also then hit by the Russia-Ukraine war, because many of the lower income countries, and not so low, middle to low income developing countries as well, the likes of Egypt and so on, were big importers of Ukraine and Russian wheat. And so you get hit with a big food price shock as well. So all of this, I'm not digressing, but all of this leads to the statement that debt levels are at precarious levels from a historical, yes.
Before, yeah. So I want to touch on, I mean, you're touching on this, social cost of sovereign default. You say here this paper investigates economic and social consequences of sovereign default on external debt. We focus on the crisis impact on real per capita GDP, infant mortality, life expectancy, poverty headcounts, and calorie supply per capita. After methodological exclusions, sample covers 221 default episodes over 1850 to 2020. The analysis adopts an eclectic empirical strategy that relies on an augmented synthetic control method and local projection. So what do you find from this paper?
So look, first of all, the big gap we were trying to fill in with this analysis is that, there are important papers, we cite these, papers, Borenstein, Panizza, others that have documented the economic costs, the GDP contracts, GDP per capita, defaults are recessionary. But you couple the fact that defaults are recessionary with the fact that they're also long lasting. And nobody's tackled the question, okay, so what does that do to the social indicators? And, in these things, the devil is in the details. And the issue why I think this question had not been addressed before is that it's very difficult to put together the data.
Yeah.
And particularly good poverty data is of more modern vintage. Okay. So that's why we importantly also rely on things that are not just the poverty head counts, but also, indicators of health, life expectancy, child mortality, caloric intake, and so on. But the big takeaway is that, during defaults, all these indicators do poorly, sometimes in absolute terms, and sometimes in relative terms. What do I mean by that? We don't find that life expectancy drops when you have default. We don't find that. However, when you do a control group and you compare the group of countries that are in default relative to the non-defaulters, when you have global medical improvements that are lengthening on the whole life expectancy, that the rate of improvement dramatically slows down for the defaulters. So it's not like life expectancy drops in absolute terms, but the they're just lagging behind the rest of the world.
Yeah, I mean, it's the
And
same
ditto
concept.
mhm.
So sorry to interrupt. It's the same concept, a distance from global median, and that distance on all these metrics seems to get higher on relative terms. But I won't be surprised, Carmen. I don't know if you find this in the data that there is absolute um, lowering of all these metrics. I'm thinking infant mortality, lifespan. I suspect there is absolute decline, not just
So,
a relative
Gil,
decline. Yeah,
that's absolutely right, but it's not universal. Okay, meaning it's
not universal.
so you find episodes that are appalling, and you don't have to go back in time. You look at Venezuela,
Yeah.
which has had, their default in 2017, so this is not ancient history, has been associated with a contraction that's estimated, because we don't have, terribly accurate national accounts, but estimated with a decline in per capita GDP of about 75%. And the absolute metrics for child mortality, uh, for not now beyond caloric intake. Sorry, go ahead. You have a you have a
Um,
question?
yeah. So can you hear me? I lost your audio for about
Oh,
30 seconds.
mhm.
Um, just move back just a little bit. Maybe that will.
So I was
Yeah.
saying
Go
that
ahead. Yeah.
you highlight correctly that you're going to find episodes that are appalling, right? That the
Yeah.
you have absolute declines in life expectancy, that you have absolute increases in child mortality, and I was highlighting that we don't need to go back that far in history to find an
Mm,
example. In 2017, the Venezuelan default,
mm,
has also been associated with what is estimated to be about a 75%
mm.
contraction in GDP. And the metrics for almost any health indicator are
Yeah.
reversals in absolute terms, increases in
Yeah.
infant mortality. Any metric of caloric intake, people lost kilos and kilos of weight because of, in some cases, that might not be a bad thing. However, one has to put this into context. These were
Yeah.
extreme, uh, scarcities, food scarcity.
Yeah.
Venezuela is very dependent on food imports, and these were absolute scarcities, and the social indicators and metrics
Mm,
declined in absolute terms. They worsened in absolute terms,
yeah.
and however, once you pool across our large set of defaults,
Mm,
we can say there's a decline in caloric intake in absolute terms. There's a decline. There's a decline in
yeah.
per capita GDP in absolute terms. But when it comes
Mm,
to infant mortality, when it comes
mm,
to life expectancy, what we observe is statistically significant,
yeah.
but slowing in the extent of global improvement. And here,
Mm,
um, uh, Gill, I wanted to point out that we use the synthetic control methods.
mm,
So the control group is
yeah.
in many dimensions, meaning per capita incomes, and debt metrics, that over the very long haul, similar between the default group and the non-default group. So we
Yeah.
have a very meaningful
Mm,
comparison.
yeah.
Um, it's when we're looking at in the control group is very important to highlight this, because medical improvements that lead to longer lifespans, that to lead to infant mortality declining, don't come also, they're not equitably dispersed globally across, the more advanced economies have obviously the better better access, the more access to state of the art, and so it's what I'm highlighting here, and I'm doing very awkwardly, is that in the control group, it is very important to have countries that have a similar income and region to the default group, so that
and
the
also,
comparison is meaningful.
Yeah. I'm also thinking, Carmen, it's a little bit of a stretch, but culture matters. So we have very poor countries, among the 200 countries that we have. They all have different cultures. And if there is a coherent social system, that gives you a lot of flexibility, that gives you a lot of structure, that doesn't break that easily. And so the data, in some sense, I wondered if there's some data to say culture into the into the regression, as a way to predict something. Yeah.
Uh, I cannot say that we examined the role of culture, and how that interacted with perhaps the outcome. But let me say the following: culture is something that doesn't necessarily change with the default.
Yeah.
Right. So you would expect that to be more perhaps prevalent in doing a cross-country comparison.
Cross-country
rather
comparison. Yeah.
rather than a time series.
Yes.
And our focus here is on the time series
Okay.
of,
Yeah.
of what happens over time to poverty, what happens over time to, rather than what happens in country A versus what happens in country B, which is because, cultural changes do come about, but they're very slow moving. And a priori, I may have good reason to expect that the poverty headcount will increase after default, for starters, because the government has no access to borrowing. So they're going to probably tighten their belts. They're going to spend less on social. There's also the question of a recession. So I have a good prior of why these social indicators will worsen after default. I don't have a good prior what will happen to culture, cultural modes. So I highlight that I would view that as more more pertinent to that cross-country comparison, which we don't focus on.
Yes. Yeah. So I want to go to something completely different topic. China as an international lender of last resort. You see here, this paper shows that China has launched a new global system for cross-border rescue lending to countries in debt distress. We built the first comprehensive data set on China's overseas bailouts between 2020 and 2021 and provide new insights into China's growing role in the global financial system. Yeah, I mean, as some Americans have been thinking about this for a variety of reasons. Um, it has, at least on the surface, it seems both positive and negative. I mean, at least somebody stepping in for countries going into default in Africa and Asia. Um,
I would not read
Maybe
it that way, by the way.
no. Okay.
I would certainly not read it that way.
Okay.
Yeah.
Tell me about this. So the key finding
Okay.
is that the global swap line network put in place by the People's Bank of China is increasingly used as a financial rescue mechanism with more than 170 billion US dollars in liquidity support extended to crisis countries. So how do you see this?
So first, I think the big question is who are they rescuing? And that's always true, right? This is not China bashing or China specific. Who are they rescuing? They're rescuing the Chinese banks that made
Yes.
these loans. Okay.
All
The
right.
same way that the Europeans and the IMF rescued the German and French banks that
Hmm.
were holding Greek debt. And
Yes.
let me backtrack a moment to put this in context. Okay.
Yeah.
China during its spectacular growth phase,
Hmm.
when it was growing double digits a year, also began, as I mentioned this earlier, they had a big appetite for commodities
Yes.
this is infrastructure investment. This is, enormous growth in spending power of uh,
Hmm.
firms and households alike. So their global demand for commodities surged, and they begin to engage in overseas lending, south to south. This is
Yeah.
lending to other countries, many low income countries
Hmm.
that would not have been able to borrow from anybody, were able to borrow from China. You
They are
may wonder.
mostly in Africa, the low income countries you're mentioning.
Mostly, but not exclusively.
Okay.
They're important. They're important countries that borrowed heavily that are not also low income.
Hmm.
I mentioned Venezuela earlier. I meant and Ecuador. They went after oil producers.
Hmm.
So they a lot of lending to oil producers, whether they were in Africa, Angola and others. Nigeria, not so much.
Yeah.
But they also made loans to Ecuador, to Venezuela,
Hmm.
and but much of their lending is concentrated in Africa, but it's not exclusive.
Hmm.
The Sri Lanka crisis was importantly also a byproduct of overborrowing, and part of that overborrowing was from China, an important
Yeah.
part. Laos, is another case.
Yeah.
The cases in South America are not limited to Ecuador and Venezuela. We have, Suriname borrowed, uh,
Hmm.
Central Asia, you know, uh,
Hmm.
Kazakhstan and others. Uh, so it was
Hmm.
global. Okay, so it was a
Yeah.
surge in lending, and China became. This is not a long-winded, but it's necessary to answer the question you posed to me.
Yeah.
China became the largest official creditor, bigger than the
Oh,
World Bank.
wow. Okay. Yeah.
Before
Yeah.
before COVID,
Before
China
COVID.
was
Yeah.
bigger than the World Bank, bigger
Hmm.
than the entire Paris Club creditors. These are your
Oh, wow.
classic
Okay.
creditors
Yeah.
combined.
Hmm.
Okay. Now, um, the fact is, we argue this we've done multiple. This is Christoph Trebisch and Sebastian Horn and I have done a series of papers
Yeah.
documenting this. And China behaved a lot like the US commercial banks in the early 80s,
Yeah.
late 70s. Commodity boom, oh, they're great, we'll lend to them. And then when commodity prices crashed, which I already alluded to, and things
Yeah.
started to, unwind in terms of growth in these countries that borrowed, their ability to
Hmm.
service debt was impaired, and entered the rescue lending. So what is this rescue
Yeah.
lending? And perhaps rescue lending, is misleading, right?
Hmm.
Because the way that China has dealt with the debt servicing difficulties of many of these countries is not uniform across
Yeah.
countries. So there are the smaller countries where smaller exposure is involved
Yeah.
from China, and those they don't get new money. Okay,
Mm.
so the typical restructuring is, okay, we'll give you a grace period, we'll extend
Mm.
your grace period, but very little else. There has been
Yeah.
very limited haircuts. That's not very little adjustment in the terms of lending. So it's mostly, okay,
No
if
change
you
in
have
the
a debt.
face value. No change in the face value of the
No,
debt.
no,
Yeah.
no, no change in face.
Yeah.
So it's promising that Zambia is a case where there, was a actual haircut, but for the most part, these are restructurings that,
Mm.
if anything, worsen
Yeah.
the net present value of debt, because you're delaying payment, but you're still accumulating it out in the future. Okay.
Yeah. So Carmen, let me ask you. So would you call this, it's a bit of a loaded term. Would you call this predator lending? I mean,
No, 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 no.
Africa,
It takes two to tango.
Africa, you know. Okay. Okay.
Okay. There's instances where there are predatory elements,
Yeah.
but
Yeah.
let me. I think it takes two to tango. These countries,
Yeah.
you know, uh, many of these countries defaulted in the 80s,
Yeah.
had their debts written off, which is also why the Paris Club creditors are not jumping the bandwagon to lend again, because they wrote off,
Yes.
and these were haircuts that wrote anything, between 85 and 100%. These were massive
Mm.
write-offs. Okay. So,
Mm.
China wanted to lend and they wanted to borrow.
So
So
they
I
fill
don't,
the gap. They fill the gap
they
in
fill
some
the gap.
ways.
However, where the
Void. Yeah.
predatory dimension comes in
Yeah.
is that this is very muscular lending style, right? Relative to any
Mm.
Paris Club creditor. So if Germany's lending, or if Norway is lending, or if the US is lending, you typically don't ask for collateral.
Yes.
And these are collateralized debts.
Okay. Mm.
So collateral, most of the debt that China has, these loans are collateralized, and also they're more on commercial terms rather than the concessional terms that you
Mm.
get from other bilateral creditors. So it's very,
Mm.
it's very muscular style of lending. But
It's
I want to
very
go back.
yeah. Yeah. It's
No,
very
no, I'm just,
strategic. Yeah.
it's very strategic. It's
Yeah.
very strategic. Um, and look, eh, in many respects, um, as I said, it's similar to the lending boom of U.S. commercial banks.
Mm.
Which, I mean, the term "everybody's a genius in a bull market," and when
Yes.
commodity prices were rising, all these countries looked like great
Yeah.
opportunities to lend. Say, ditto, China fell into the same trap.
Yeah.
Um, where it looks very different is that, in the lending, one cannot deny that China also had political considerations in terms of,
Mm.
a strategy about, supplying itself with commodities, a
Mm.
strategy perhaps about, geopolitical. This,
Mm.
you lend to Djibouti because we
Mm.
can put a base there. And those kinds of considerations were absent from the private lending. Okay.
So let me so sorry to interrupt, Carmen. Let me ask you this. So I grew up very close to Sri Lanka in South India,
Yeah.
and the story that I have heard was that this collateralized loans, and China goes back in there and takes the ports of another country because maybe it's collateralized from the ports. Is there anything to it?
That it's plausible. It is very okay. People do melodramatic moments
Yes.
here.
Yes.
oh my God, they're going to own the country. They're going to take the port. It's often
Yeah.
not that kind of collateral. Most clearly, the collateral, there is a big collateral with teeth, which is what,
Mm.
Venezuela, Ecuador, Angola, look, you can't pay, you ship oil to me. You repay an oil.
Okay.
Okay.
So,
That's
okay.
that's collateral. Okay. Uh, then there are the escrow accounts in which
Yeah.
countries like Sri Lanka. So you open an escrow account that China has access to, you do not.
Yeah.
So, and you can't pay. So there is a withdrawal from
I
the,
see. Okay.
now, getting to the melodrama part. Sometimes it's
Yeah.
pretty melodramatic, like, in Laos, less so in Sri Lanka. Laos, China owns the entire utilities of the
Oh my
country
God. Yeah.
because they they
Hmm.
they, they couldn't repay, so China owns the entire utilities.
Hmm.
And so what I am getting at is that when the term rescue, people see rescue lending correctly,
Yeah.
it reads like rescue, but it's like, oh, Greece was also rescued, right? Well, really
Yes.
it wasn't.
Yeah.
And it is the countries that are getting the new lending, that are
Hmm.
getting the countries that have access to the PBOC swap line, the People's Bank swap line.
Yeah.
Those are the bigger
Yeah.
borrowers where,
Yeah.
it's the old story. If you owe the bank a little money and you can't pay, you have a problem. If you owe them a lot of money, it's the bank's problem. Uh,
Yeah.
so
Yeah.
it's that,
It's that
it's
type
so
of a thing. Yeah.
so that the larger borrowers
Yeah.
have, you're doing this, uh
Yeah.
like, efforts to do bridge loans to see if things get better. The
Yes.
smaller
Yeah.
borrowers, you know Chinese lending, net new flows have come
Yeah.
to a sudden stop,
Yeah.
and this was before COVID. In 2018 they
Oh,
peaked and have been
okay.
declining and becoming more negative.
Yeah.
And this is, again, not unlike the reversal in lending that we saw in U.S. commercial banks,
Hmm.
once commodity prices, soured, and the ability of countries to repay debts worsened. You don't get,
Yeah.
so it's not like, oh, the IMF is going to be displaced by, no. This is not
Hmm.
that kind of lending. Um, the lending these countries are getting,
Yeah.
and they got during COVID, and subsequently continues to be from the official multilateral institutions. The IMF,
Yeah. I
the
mean,
World Bank, the regional banks, development
yeah. I
banks.
mean, there are economists there who are optimizing the problem. I'm fond of saying China is the best capitalist on earth today. We don't have that good a capitalist anywhere in the world of the 200 countries. They're truly a very good profit maximizing capitalist, and they can package their things in such a way that they're good marketers too. I mean,
Indeed,
they're
indeed.
going places. Yeah, they're going places, looks like. So I want to touch on another paper, Debt Distress on China's Belt and Road. You see here, this paper shows that China's lending boom to developing countries' sovereigns has largely ended, and that debt distress and defaults are increasingly common.
Yeah,
Chinese lenders react to this challenge through two main coping strategies. First, bilateral sovereign debt restructurings, typically with maturity extensions, but no face value cuts. And second, rescue loans that allow debtors to avoid delay default. Yeah, so we talked about this. Um, what is the connection to the Belt and Road um, initiative here in terms of lending?
look, let me put it this way: the Belt and Road is really, it has elements of symbolism more than reality. The reality
Yeah,
is China was lending, a decade. very aggressive lending, a lot of lending, south-south, uh, well before the term, which sounds so evocative, the Belt and Road term was coined. So, Belt and Road can mean whatever, but the fact is the lending doesn't follow a specific geographical pattern, certainly that could be connected to and the timing of it preceded the Belt and Road. But the term is often used as lumping together all the China's lending to developing and emerging markets. But I'm glad you pointed out the
A
capitalist
portfolio of
dimension.
strategies, a portfolio of strategies, so to speak. They're clearly good at customizing strategy by country, and they're really doing it well, I would say.
But let me say,
Yeah,
they
yeah,
have massive losses in their hands, massive.
yeah,
I mean, in that
yeah,
regard, look, they and okay, they are very, very savvy in terms
yeah.
of writing those contracts, in terms of the terms they offer, but they fell into the same mistake
Same
as the
trap.
U.S. commercial banks,
Yes.
did. Commodity
Yeah,
prices are high; they're going to stay high. Therefore, repayment
yeah,
should be no problem. Let's lend, and there was a lending frenzy. And
yeah,
this is internal discussions that I've had from various people, various
yeah.
institutions on the lending side, on the China lending side. There was like
Yeah.
competition of who's going to lend more. So you
Yes.
and now you have a fairly impaired loan
Yeah.
portfolio. Uh,
Yeah. Yeah.
um, and that is actually quite unfortunate because we hear a lot
Yeah.
about the domestic portfolio being quite impaired because of real estate loans and similar boom bust, right?
Same issue.
The
Yeah.
same issue,
Yeah.
except the boom there was in domestic land prices,
Hmm.
and that and provincial
Yeah.
borrowing. And the bust came, of course, when uh, land prices stopped increasing and began to, and
Yeah.
the analog on the international side is what we've been
Yeah.
discussing. During the boom they couldn't lend fast enough,
Yeah.
and now they are retrenching, much like we saw the commercial banks retrench
Hmm.
again, to highlight that this rescue lending is selective and it is importantly connected to
Yeah.
countries where the exposure of the domestic
Yeah.
institution is larger.
Yeah. I always felt, Carmen, that commodities are a losing game. So if a country is going out sequestering oil and copper, that's going to end in tears. uh, I thought 5 years ago. Yeah. Yeah.
It usually has. It
Yes.
usually
Yes.
has. I mean, it's it.
Yeah.
Uh, Look, in my book with Ken Rogoff, This Time is Different, which is meant to be an ironic title. It's always, that during the height of the boom, the eternal optimism that, oh yeah, no, but now, I can tell you a very important story of why, given technology shifts, given our change in policy, given this and that, this time
Hmm.
the prices will be high forever. And that extrapolation is very costly,
Yeah.
and it usually ends in tears. And that
Yeah.
is a big message,
Yeah.
of a lot of the work that I've done, which we've been discussing here, but a lot of my work on crises,
Yeah.
whether they're debt crises, inflation crises, or currency crashes, they or banking, they often stem from expecting that the good times will last and that the bad times are things that happen to other people. You know.
Yeah, this is not in your research, Carmen, but we'll go on to another paper and finish up with that. So I think the AI thing is going to make this thing worse because we were just doing simple regressions before. Now we can ask an LLM what's going to happen in Zambia tomorrow. It's going to tell you precisely what's
Yeah.
going to happen to Zambia. And so if all the policymakers start using all this AI stuff that's out there, I think we have a huge crisis on our hands here. So I want to finish up with something completely
Let me say they've
different.
been doing pretty well in delivering crises without AI. So
Yes, yes, we can make it much worse, is what I'm saying. Yeah. Let's not look forward to it. So, this is something that I never thought about, Carmen. So, decrypting new age international capital flows. So, you say here this paper employs high frequency transactions data on the world's two oldest and most extensive centralized peer to peer Bitcoin markets, enabling trade in the currencies of more than 160 countries. We develop an algorithm that allows us with high probability to detect crypto vehicle transactions in which a cryptocurrency is used to move capital across borders and or to exchange one fiat currency for another. Yeah, this is such an interesting concept. And so, can you talk briefly about the mechanics of how one might do this?
look, before crypto, you know, capital flight and parallel markets, black market activity is older than the hills. You know,
Yeah,
it's
yeah, for sure. Yeah,
it's yeah. And but let me just backtrack a second and say one of the things we wanted to establish in this paper was that
yeah.
beyond just the whole issue of, which has now become more widely accepted, I would say, but
Hmm.
when we were still writing this, the view that, it was all speculative. Crypto was, what we were highlighting in
Hmm.
this is, look, there's a transactions
Yeah,
motive here. That
yeah.
in periods in which you have capital controls, in which you have crises, or you have no
Hmm.
faith in the local currency,
Yeah.
purchasing crypto offers a way of acquiring dollars.
Sort of
Um,
displacing crisis. If there's a localized crisis, you could possibly use crypto to sort of move it some
uh,
ways.
but well, I mean,
Yeah,
no, I mean, the crisis is still localized. I mean, in that,
yeah,
I'm not saying that spillovers can be,
yeah,
and I'll highlight an example of exactly what you just said, which
yeah.
is how the spillovers occur. But the crisis is still there. I mean,
Yes,
Lebanon was having a crisis because, oh my God, the list
yes.
is so long. But
Yeah.
the point being that the crisis led people to, whose value of their savings were disappearing before their eyes to try to, you know, you transfer funds to, you try to get dollars
Hmm.
uh, using the new options. Um,
So crypto
similar,
then becomes sort of a global currency where I can bank value. So suppose I have high
it's it,
inflation.
it's
Yeah,
it's it, what you can do is be sure you can trace, right? You can
yeah.
trace your transfers. Um, and I was going where you just went, that it's not just, we think, oh, but this usage that you're stressing, capital flight,
Yeah.
is limited to, the countries where there are underlying crises. But no, the usage is a lot more general. What about remittances? Remittances are a
Hmm.
global. there's so important for so many countries, crisis
Yeah.
or no crisis,
Yeah.
and often remittances can be, the quite costly. Transactions cost, and crypto
No.
is reducing the cost
Yeah.
of remittances.
Oh, wow.
So
Okay. Yeah.
the
Yeah. I see that.
so
Yeah.
so the point that we make in this is, look, we're used to thinking of crypto as speculative and this, but it offers
Mm.
transactions. It has a role as an asset facilitating certain transactions. We give the example of capital flight during crises, but we also have the generalized case of
Yeah.
lowering transactions costs for remittances.
Yeah. So
Now,
crypto as a, yeah,
I want to go
crypto as
back to
a
one issue you
transaction
mentioned.
lowering mechanism. Yeah. A transaction cost lowering mechanism.
Yeah,
That's really interesting. And it could be applied in a lot of different contexts. Yeah, as you say, crisis or no crisis, I can I can likely reduce even currency
indeed.
exchange transactions. I fly
Yeah.
into Milan, I go to the airport, and I try to change dollars into Italian currency. They take 5%.
Yeah, yeah, no,
Um,
it's at Western
yeah,
Union with the
yeah,
transfers. The the cost, the reduction cost is quite important. This is something the World Bank has also written on.
hmm,
Um, you know, um, and I wanted to go back to something you
yeah, yeah,
raised on the spillover issue.
yeah,
So I made the point that I stick to, the crisis is a crisis that's domestic. However,
yeah,
the disturbances and the people seeking to take their money out
hmm,
of the country can and does have spillovers. We're
yeah,
seeing in South America a little known example, but it's here in real time. Bolivia is going. Bolivia is. It's a matter of time when they have the crisis. I don't know the time, but it's heading at that. So the black,
you making a prediction.
yeah, I'm vague on the time, but they're really quickly heading in that direction. Their black
Yeah.
market, their parallel market has taken off, and there's a massive dollar shortage, and
Hmm.
so the Bolivians are going into the crypto market in nearby Paraguay also. And Paraguay's been losing some of its dollars because they've been flowing to Bolivia. So, you know,
Hmm.
you get what I'm saying, which is, but listen, I think we are, you
Yeah,
know,
we ran out
covered a
of
lot of
time.
ground, but
Yeah, yeah.
uh,
Excellent. Yeah. Thanks, Carmen. Yeah, thanks for spending time with me. I really enjoyed
well,
it.
Gill, it's been a
Thank you.
pleasure. It's been a pleasure, and I think there's, we could go on for another 2 hours, but we
We could
won't.
go on for another 3 hours, I think, but
Yes,
excellent. Yeah, thanks again.
you're
Thank
quite
you.
welcome. Bye bye.
Bye.